Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our weekly financial markets review here on Core Finance. Now, my special guest this morning, and Jeremy, thank you for turning up. I'm sure you were probably out celebrating last night. Jeremy Stretch, Chief FX Strategist at CIBC. Well, I guess the question is, as I was telling all of our clients yesterday, be prepared for a very dull FOMC statement. Well, I think she outdid herself last night. It was even duller than anybody expected.
I wouldn't say it was duller than anybody expected, but I think it takes us back to a different era. It takes us back to the era of Mr. Greenspan, where you're left to sort of look at the statement and check for the subtle moving of a comma or something similar. So we've gone from inflation from being somewhat below 2% to now below, which is an implication as perhaps a slightly more dovish bias, and obviously the reference to the fairly soon adjustments in the balance sheet, which again gives you enough opacity to say, well, is it September or is it going to be later in the year?
Question, with your last comments, confusing me and everybody else, have you ever thought about being chairman of the Federal Reserve?
I'm not sure they've had a non-US. Here in the UK, we're quite happy to have an international membership of the central bank governing board and indeed the governor. Probably not convinced that the Federal Reserve is quite ready for that, particularly under Mr. Trump as the selector of the next Fed chair.
Because I mean, I know we've talked before, and I know I will have to say I wasn't in the beginning of the year feeling parity for the euro and one maybe 15. I thought that was too much. But I guess my next question is, when will somebody start saying, let's holler for the dollar?
Well, I think if we go back to last autumn, and of course we were in the election campaign, the big claim from the Trump campaign was make America great again, so to boost manufacturing exports. Well, of course, when we had that advance in the dollar in the immediate aftermath of the election as people were buying into the reflation trade, that was not consistent with making America great again by allowing some currency competitiveness. Now, obviously, we've seen that those dollar gains eroded and more, so we're now substantially below the level.
Eroded or tsunami'd?
Well, it's certainly been a very progressive reversal of euro holdings, dollar holdings. I guess the question is how long before it becomes a macroeconomic issue, a macroeconomic problem. Now, in a sense, because the US are not heavily involved in terms of foreign travel, so when you get to the summer holiday season, you don't suddenly find that your population are finding that your domestic currency doesn't go as far and clamoring for a stronger dollar. So as long as the export sector is arguing that it's getting a benefit from this and it's not creating an inflation spike, because of course inflation is still conspicuous by its absence as far as the US and probably most other markets are concerned, then I think the authorities will be quite happy to tolerate a cheapening up of the dollar. And the question is, what's going to be the thing that turns it? And I think it will only be better data. I think that will be a question.
I guess the question is, and I think this is one of the things that we understand, okay? I mean, when we started, and this goes back to when Ronald Reagan chose Paul Volcker to be chairman of the Federal Reserve, and basically at that time we had mid-20s%. And I remember Volcker telling President Reagan that one of the first things he wants to do was kill inflation. And Reagan's comment was, just don't get caught. So let's look at a couple of the charts. And unfortunately, most of these charts were done midday yesterday before we had the major decline in the dollar last night. And looking at the euro, okay? We both have talked 118 by the end of the year. But now how high could high be?
Well, you're right. We've both been on a very similar page in terms of anticipating a strong euro rally, and that's been something we've been recommending to our clients for certainly the last few months, and that those trades have worked very well. We've almost hit our take profit target at 180.
You and everybody else.
Probably about 5 months earlier than we thought. Yes. Now the question is, if we can go up through 118, where do we go from here? And I think it's interesting because if you get up through the sort of 118.77 area, then inevitably people will be raising their forecast to 125, 130. That's probably a little too aggressive. But I think a level that's fascinating to keep in mind is 120.43, which is the low that we saw in July 2012. And that July 2012 low is fascinating because, of course, that was just 2 days before Super Mario made his previously large speech about doing whatever it takes to save the euro. So We've just passed that 5th year anniversary. That 120.43 level, I think, is increasingly coming back into view, unless Mr. Draghi pushes back against what is increasingly being priced into the market at Jackson Hole. And I think there's certainly going to be a binary reaction to what he says at Jackson Hole.
Are we now, could Jackson Hole be Sintra Part 2 and reiterates, and could, as you say, if we got that same type, could then we see that 120.43 coming very quickly on the radar screen?
Well, I think as we sit here today, where markets are looking for signals from central banks. So when Draghi didn't push back against the Sintra message last week, then the euro appreciated. When there was a small scintilla of dovishness in the context of last night's Fed statement, the market again reacted very aggressively. So if there were to be a perception of Jackson Hole being Sintra Part 2, then inevitably, despite the long nature of the market in terms of euros, there is going to be that further step change adjustment, and that could be the catalyst to get us up towards that sort of 120 area.
Because the one thing I noticed after re-examining, the statement from the Federal Reserve, it basically caught. If you look at the CFTC data, I know this is a generalization, but the CFTC data seemed to set the position that no, they weren't going to be overly hawkish, but they were going to be more hawkish than they were last night. And people really got caught very quickly.
I think that's true. I mean, I think certainly when you look at some of the way that the markets have been positioned according to CFTC data, clearly dollar yen was a big variable. So in that context, that correction that we saw in dollar yen in the immediate aftermath of the Fed probably caught a lot of people once again, because of course we've already seen one move lower down to the sort of 110, 60, 70 level earlier in the week. We've now seen a second one, and that's probably...
Let's look at cable first, because we have the yen chart. So let's look at cable. I mean, as you've seen, wild variation, but the question is, we're now well above that 130.50 level, okay? And I mean, people were talking like, let's say 3 months ago, well, we were going to be the 128 heading towards 125. And there were some people out there who were saying, watch out for 132 to 133. And I think a lot of people say, well, whatever he's drinking, I'll have a double.
No, that's right. I mean, certainly I've heard of smarter investors who've been arguing that we were going to go back to 134. Now, I think in the context of what we're seeing is that we're seeing euro dollar going up exponentially. We're seeing euro sterling going up as well, but not at the same pace. And hence, the byproduct of that is a higher value of cable. We've seen short positions progressively squeezed out of the system as regards the UK, partly in an expectation of some arguing that the Bank of England was still in play this year. I don't believe that, and I think that's very unrealistic. But if we are going to see euro dollar going higher and we don't see euro sterling at, say, 95, then inevitably you're going to see the pressure point, the release valve being in cable.
Most everybody I've seen is basically saying, and we got very close if we didn't do euro sterling at 90. I mean, everyone's saying, well, that's as high as it's going to go, because it's quite a situation. The struggle seems to be more euro sterling than either euro dollar or sterling dollar.
I think it is. Now, traditionally, when you've had political uncertainty in the UK, you play it via cable. But I think in this context, and particularly because of the nature of the negotiations, which are evidently between the UK and the Eurozone, it's the euro-sterling pair that's really the main point of, or the path of least resistance. So I think if we are going to see pressure point in terms of the negotiations between the UK and Europe, that will come via interest to continue to buy euro-sterling. Now, I think that we're most likely going to go through that 90 threshold, probably with a reasonable degree of conviction now, because I think there are still eminently more problems to be seen from the UK side. I think the growth trajectory is going to diminish still further. I think that 0.3 print is still going to be probably more of a high watermark than a low watermark. I mean, first half of this year has been the slowest since 2012. So I think the pressure point will be in euro sterling. So I think we will easily see 91.5, maybe 92 pence now as a potential high. And so that's the way that we're going to trade it. But euro dollar will probably keep cable relatively well supported.
Cable. I mean, the question that I keep getting, and it even surprises me. I mean, it's the correlation between the FTSE and cable. I mean, it's like 80-some%. FTSE goes up, cable goes down, and vice versa. I mean, it's been interesting. Like the last couple of days, it's broken that correlation. But how concerned are businesses with if the euro keeps going, I mean, if sterling keeps going 130, 131, 132, if you are a UK business, how do you position, forget Brexit, how do you position your future projections?
Well, it is remarkably difficult because, of course, most businesses have a lot of dollar-denominated costs because, of course, most commodities are bought in dollars, so there is clearly an interest there. And, of course, one of the reasons why the FTSE performed so well in the aftermath of Brexit was that repatriation value factor when those foreign earnings, predominantly dollars, but largely foreign.
You mean
earnings.
like companies like HSBC, right?
So when you had the big players bringing those profits back onshore, back in determining them in sterling. So clearly, if we are going to see a squeeze up towards maybe 134, then that is going to cause some consternation in terms of the earnings. Obviously, it's going to have some impact on a slightly more beneficial level in terms of the costs, but it is going to make it increasingly difficult to try and analyze one's balance sheet, and certainly it's going to be making it much more difficult for equity analysts to come to a reasonable conclusion about where the FTSE should be at the end of the year, for example.
And I guess forget Brexit, but if you are a UK-based company, does that affect, if we're 133, 134, 135, getting back to where we were pre-Brexit in June of last year, does that go into their thinking about hiring here in the UK, possibly setting up subsidiaries in the Eurozone, or will that?
I wouldn't have thought it would do to that extent. I mean, clearly, when you're thinking about currency volatility and currency movements, then if you're a corporate treasurer, then you need to think about hedging those risks. You need to think about putting in play option strategies to try and mitigate that risk. Are we seeing the sort of volatility or the sort of questioning which will actually make business decisions to such a degree that we will see divestment or at least changing in the investment patterns? I don't think purely on the basis of the currency. I think there are bigger issues at play, as we well know,
yes,
in the context of the big picture decisions on investment and so forth. But I don't think the currency volatility in itself is going to be of a sufficient magnitude to actually create that degree of.
Well, we've seen two charts of up and away. Well, let's look at the third chart if anybody has a yen for looking at this chart. Now, how low do we go?
Well, I think it's interesting because, of course, we're talking about the Fed and the market interpretation of where the Fed is going. The one thing that we do know is the Bank of Japan is going nowhere fast.
Well, they've delayed it for another year, right?
Indeed. So they pushed forward the attainment of their inflation target for another year to the end of fiscal year 19, which, of course, when you think about it, is actually March 2020. So they're already nearly 3 years away from their inflation target. We know from the language that we saw from the new BOJ members who were just joining the board in the last few days that they generally are of a relatively dovish bias, as one would suspect after being chosen by Prime Minister Abe. So the BOJ are really going nowhere fast. So I think we can safely say that is the case. So the question is, if we start to see, I think we've seen US Treasury yields coming off probably a little bit too far. If we see US Treasury yields getting some support and grinding back higher over time, then I think that will actually help arrest the slide in dollar yen.
I know if you're a technician, I know that 111, 112 is both a 50, 100, and 200-day moving average. So you've almost got this tug of war between the fundamentalists and the technicians.
Absolutely
who
right.
may or may not win.
You absolutely do, and you're right that we have seen that sort of consolidation in terms of those moving averages. Clearly, we need to see a weekly close above the 200-day, which I think is currently 112.12. So if we can get above there, then I think that will change the trend a little. I was talking to one of my colleagues who's worked in Japan, has very close contacts with the BOJ, and he's convinced that dollar yen is going to 120. Well, I have not that degree of conviction. However, I would say
what is he using as his thought process?
Well, he's working on the principle that the BOJ will do whatever it takes to keep the yen very much on a cheapening path, because, of course, the one way to provide some stimulus in terms of imported inflation is to cheapen up your currency. So his argument is the BOJ will continue to inject.
For so many Japanese companies, it's got to be, as they would say on Strictly Come Down, a disaster, darling.
Well, indeed, and in a sense, the reality is, of course, because of the increasing degree of transplantation of Japanese production outside of the borders of Japan anyway, that the impact from the export side from a cheapening up of the currency is mitigated, but the Japanese are trying to create inflation. And so, as I say, if they can create that by keeping the currency cheap, but they do need to see the US playing a little bit of ball, and I think the key variable there will be Treasury JGB spreads. The BOJ are clearly holding yields at zero or effectively zero. So if we can see just a little bit of reversal in terms of some of this downtrend in Treasury yields, then I think that will help to arrest that downward trend
Yeah,
in
very
terms
quickly.
of dollar yen.
Next press conference meeting is the 20th of September. The announcement there that they probably start the normalization in October, and the market's still implying about a 44-46% probability we get another hike in December and possibly 2 next year. Agreed? Will that make any difference if we get a new Fed chairman next year?
Well, of course, this is the other big variable that we don't really know how it's going to play out. We still don't know who will be the Fed chair from February onwards. Now, in a sense, clearly the identity of that person, whether it could be Janet Yellen being reappointed or others, that will have an implication in terms of what's priced in. So we have the dot projections now, and we have those to work with. The question is, how will the new Fed chair or the incumbent Fed chair being transposed deal with the interpretation of the economy
And
going
I guess,
forward?
again, the last question is, does the market want the next Fed chair to be a business person rather than an academic?
I'm not so sure the market has a strong view whether they want an academic or a business person. I think that what they want is somebody who's actually going to do the optimal for the market in terms of the best decision making in the concept of the twin targets of the Fed. So I think what we don't want to see is somebody who is perceived, rightly or wrongly, to have the thumbprints of the US administration all over their appointment. So I think somebody who has independence, I think, is probably to be most guarded. And I think that's probably one of the reasons why markets may be a little bit wary of somebody like Gary Cohn, who, of course, has been brought into the US administration, perhaps under the auspices of giving him the Fed chair in 2018.
Well, Jeremy, what can I say? I mean, I hate to end this. I mean, the excitement level of all of our viewers today has got to be phenomenal. So let me just say, Jeremy Stretch, thank you very much for joining us.
Thanks very much, Bill. Great to be here.
I hope you'll have the courage to return next month. Thank you very much.